Good afternoon, friends, and thank you very much for joining us. My name is Ganesh from Hdfc Securities, and today we're going to be talking about the much awaited Bharat Bond ETF Series 2. We at Hdfc Securities have always stressed the importance of asset allocations and investments. And with the current volatility and the anxiety in the markets that we see today, I think it makes a lot of sense for us to look at avenues which gives exposure to high quality PSU bonds, more so through the ETF route. And to tell us more about this, we have with us today Mr. Deepak Jain, who heads the retail and institutional business for Edelweiss AMC. Edelweiss AMC is the AMC that will be managing this issue of Bharat Bond ETF Series 2. So, Deepak, it's over to you now.
Thanks a lot, Ganesh. You really highlighted the most important point about high quality and asset allocation. I think in today's world, both of them have acquired a special meaning in clients' portfolio. So with that context in mind, what I'll do is that I'll quickly touch upon the basics of Bharat Bond program, the context, a little bit of background, the ETF itself, how is it constructed, and some features which are very common to any debt ETF. I'll talk about them, and then we can take questions and answers, and answer all of them one by one. So to start with, let me try and explain what exactly is a debt ETF all about. Now we know that the moment we talk about ETF, two things comes to our mind. One is that the fact that it is a mutual fund which is tradable on an exchange platform, and second, it generally copies an index or mirrors an index. So if you had a Nifty 50 ETF, you would have Nifty 50 companies being replicated in that ETF, and that ETF would be available for you to trade like any other security on the stock exchange platform. So it's called more of a passive strategy. But when it comes to debt ETF, I would hesitate to use the word passive. I would like to call it a rule-based approach towards investment. Now, why I say rule-based approach towards investment instead of passive? In a passive strategy, you just copy whatever is there in the underlying index, and then you just leave it at that. In debt ETF, exactly mirroring an index is almost next to impossible. When I say that, I say it with great responsibility, having studied the global practices, phenomenon. And this lies in the different aspect of the equity versus debt ETF. An equity ETF is represented by, an equity security is represented by one security. So for example, if you have to invest in HDFC Bank, there is an HDFC Bank security or a share which is available, and you can actually buy and sell. But at the same time, if you want to buy a debt of another company, let's say Power Finance Corporation, Rural REC, IOC, HPCL, for example, there'll be debt securities of varying maturities, of varying tenures, of varying coupons, each security having a different identification number. So you cannot just buy all of them and replicate the risk or the returns that are represented by HPCL, for instance. But when you buy an equity, the equity security is only one. So hence, it's not possible to mirror an index. So for example, let's just go by Bharat Bond example. If you see that in an index HPCL has 20 ISINs, I cannot buy 20 ISINs. What I'll do is I'll buy one of the ISINs or a fresh issuance of HPCL bonds, which the government intends to do. So it's a rule-based approach towards investment. The rules are predefined. What will the rule say? The rule will say which kind of securities you can have, how much issuer weightages you can have, and how will you do your rebalancing and in what frequency. Once those are decided, index is constructed, and then the ETF tends to follow that index. So in simple, a debt ETF is a rule-based approach towards investing, and second, it allows you transparency and ability to exchange on the trade on the exchange. Now let's talk about Bharat Bond ETF. So Bharat Bond ETF was conceived way back in 2017 when late Shri Arun Jaitley in one of his budget speeches mentioned the need for launching a a debt ETF program similar on the lines of the equity program. The equity program was intended to support the disinvestment cause. The debt program, the debt ETF program is intended to do a couple of things. One, of course, make available another source of borrowing for high quality, centrally owned public sector enterprises. The second was to make available these bonds to retail investors in the most convenient and low cost format, and to deepen the bond market via doing both of them. So you solve a problem of a borrower as well as solve the problem of somebody who wants to invest or be a lender. Today, if you want to invest in some of these bonds individually, the lot size is 10 lakhs or more. So if you want to construct a portfolio of some of these bonds, it may require you to spend 1 crore, 2 crore, and even then you may not be able to do it efficiently, because not all times you will find them to be available at a convenient and price which is very self-determined. So a Bharat Bond ETF will try to achieve that objective. With that objective in mind, in 2019 January, a request for proposal was initiated, bids were invited. Edelweiss also participated in that bid process, and we won that mandate. Having won the mandate, our job was to advise on the construct of the ETF. What will be the ETF looking like? Because when you talk about debt, there are various kinds of debt products that we see: active management, passive management, roll down, so on and so forth. So it was important for us to recommend a construct, and second, launch the product and manage it. In order to do the first part, we studied the global best practices. We also looked at Indian investors' psyche, and we came to a conclusion that a product with a fixed defined maturity, we call it target maturity, a target maturity, and mostly comprising of AAA names would find great interest among investors. So a target maturity bond ETF is nothing but I would say a more liquid version of a roll down or an FMP kind of a strategy, and I'll come to that when I explain further how is it similar or different than some of the products. So a target maturity bond ETF does the following. It collects the money from all the investors. It invests in the underlying bonds as per the rules set down, and the ETF along with the bond matures on a given day. So if ETF is maturing on, let's say, 15th of April 2025, the bonds also mature within a few days space. So basically, it acts like a bond, and it gives you the benefit of a mutual fund. I'll come more on that if there is a need. So we advised the government on launching the target maturity, and it was accepted. In December 2019, we launched our first series. The first series we launched 3-year maturity and 10-year maturity. The idea is to, over a period of time, launch various buckets of maturities of debt ETF, so that if you want to invest for 1 year or 10 years, you will have a product for all the possible tenures. So when you go to a bank, if you want to invest for 6 years, you get a bank FD. If you want to invest for 3 years, you get a bank FD. If you want to invest even for 1 year, you get a bank FD. Similarly, an investor should be able to make that choice. And once we launch all the securities from 1 year to 10 year, and some of these you may have from or more than that. So अगर आपके पास 10 दिन का भी पैसा रहेगा and there is a ETF which is maturing after 10 days, you can invest, and then at the end of the maturity you can take your proceeds. So that will really open up a lot of avenues and opportunities for investors, and you can match the goal of an investor with a particular ETF. So we launched 3-year and 10-year. We collected more than 12,500 crore. The current size is 14,000 crore. In the new issue, we are going to launch a 5-year and 11-year. As I said, with our launches, we will look at two things. One, we will look at the possibility of completing the range, and second, we'll look at which end of the segment one finds most value in value. When I say value, I mean which is the most attractive segment for investors from a returns point of view as well. So if you look at 3-year today, 3-year Bharat Bond ETF is trading at 5.1, whereas the new ETF can give you a 50, 60, 70 basis point extra return on a 5-year side, which was not the case 6 months ago. 6 months ago, 3-year and 5-year were trading in the same range. Today, there is a 50 or 2 to 70 basis point spread, which is available on 3-year. On 11-year, see, when we launched Bharat Bond last year, we launched it in April with 10-year 4 months. The moment we launch another 10-year, in 2 months time, you will actually lose that 10-year thing and it becomes 9.5 years. So the idea is to launch a 10-year, 10 months kind of a product and then give that option for people to come in both during the NFO and post the NFO, because in 6 month time, the old 10-year will become 9-year. So with that, we are launching the 5-year and 10-year. Now, in terms of underlying, like Bharat Bond 1, Bharat Bond 2 will also have only AAA CPSE issuers. Now, what I'm going to do is I'm going to show you the index portfolio for your direct perusal at this point in time, so that one can have a look at what the index looks like. So if you look at Bharat Bond 2025, you would find all AAA CPSE issuers: Power Finance Corporation, REC, Power Grid, NHB, IOC, NABARD, etc. And so is the case with April 2031. All AAA CPSE issuers: Goodco, NHPC, IRFC, Nuclear Power, NHAI, etc. And the point that I was trying to make earlier, why a debt ETF cannot exactly mirror the index, is getting highlighted by number of ISINs. So there are only 12 issuers, but there are 83 ISINs. So it's absolutely next to impossible for one to buy all the ISINs. What we will do is that we will have a PFC issue a fresh bond of matching maturity of this particular ETF. We'll have REC issue a bond of matching maturity, and this way we'll be able to deploy all the money that we collect. So this is how the index looks like, and the idea of the ETF will be to follow this index in as much similarity as possible. In terms of taxation, so since it's a mutual fund, it will attract capital gains taxation whenever we decide to sell the fund. If we decide to sell the fund after holding it for 3 years, then we will be eligible for long-term capital gains. But if we so decide to sell it before 3 years, then it will be short-term capital gain. So let me just give you an indexation example. On your left, we are showing you the 2025 ETF, and on the right we are showing the 2031 ETF, and we have taken tax as same and returns as same, and try to understand what is the post-tax return looking like, assuming the current rate of index return. So at 564, the 5-year can give a post-tax returns of 535 compared to a traditional investment of FD, etc., which will only give 4%. Similarly, Bharat Bond 2031 ETF can give a post-tax return of 6.3%. We have assumed an inflation of 4%. If you think that inflation is going to be lower or higher, you can actually do that as well. The biggest comparable product which is available from a post-tax perspective is a tax-free bond. So today, a 5-year tax-free bond of similar underlying papers like REC, etc., is trading at 435 to 450, and a longer maturity tax-free bond is available at 460, 470. So over tax-free bonds on a 10-year, you're getting more than 1%, and over 5 years, you're getting more than 75 basis point. So it's a win-win kind of a situation for both investors as well as people like us who are trying to position it for a suitable investment opportunity. Also, people tend to ask me questions, Deepak, how does it compare with an FMP? How does it compare with a roll down structure? How does it compare with a normal bond? So, I try to talk about it in a very simple terms. So what does a bond do? A bond borrows from you and pays coupons intermittently, and then pays out the maturity at the end of the tenure. So in that sense, Bharat bond is also like a bond. It takes money from you. It has a YTM, and so it's the ETF receives annual coupons from the underlying bonds. Those coupons are reinvested, and then at the end of the period, the entire money is returned. But the biggest difference is that it does not borrow; it is managing money for you. So it is not a bond; it is a mutual fund after all. Comparison with FMP, yes, and FMP also one can lock in the yields, but the biggest difference is the liquidity. In an FMP, you cannot liquidate your investments before the maturity. In ETF, you have options to liquidate either in the form of liquidating it on exchange or through FOF mechanism. And I will talk about FOF and ETF after this example. And the third thing is, how does it compare with a roll down? So a roll down and Bharat bond ETF are similar in construct. The only difference being that Bharat bond is an investment objective in itself, whereas a roll down is a strategy which is followed in one of the funds. That can only be done in 3 funds: dynamic bond fund, corporate bond fund, and banking and PSU one. So as an investor, you would never know by your own whether it is a roll down or not. You will have to find out, and you can only run 3 strategies at a time. Whereas in case of Bharat bond, as I said, we will have ladders of ETFs. You can invest as per your choice. You can invest for 1 year, 2 year, 5 year, over a period of time, and match your goal with your investment choice. Having said that, let's look at the construct of both ETF and FOF. So Bharat bond ETF can have will have to have a minimum 8 issuers. Not one issuer can have more than 15% weightage, and you cannot go out of the index for more than 20%. And these are SEBI guidelines. We have not changed anything. We will just follow what the SEBI requires us to do. And the expense ratio is 0.0005, which means it is lower than the stamp duty. Today, the stamp duty on mutual fund is 0.05. So Bharat bond expense ratio, the management cost that you pay for, is 1/10 of the stamp duty. So for every crore of rupees, the cost is only 50 rupees, which is the lowest cost bond fund in the world. I would like to assume, because I haven't seen anything which is more cheaper than this. In FOF though, there is a 5 bips expense. So people ask me what is the difference between fund of fund and the ETF. There are 2 major differences. One is that this expense ratio, and the second difference is liquidity. So FOF works like a mutual fund. Absolutely, you can invest any amount, redeem any amount at any point in time. There is no problem. In ETF, there are only 2 things. One is that you can redeem through exchange, and its liquidity is very well defined. But you cannot come to AMC directly to redeem unless you have 25 crore or more of units to either redeem or purchase. You have to liquidate only on the exchange. So since we talked about liquidity, let me show you our experiences with the previous 2 series that we had launched in December, and how the liquidity has been. So if you look at, so this is the average volumes on exchange. So on an average, we have seen 6-7 crores of trades happening on the ETF platform. So for a retail investor, this is enough. In fact, if you find even on equity ETF, you will not find 6-7 crores of average volumes. In fact, in a period like March where people really were struggling for liquidity, the volumes had gone up to 30-40 crores. I'm sure even on the HDFC platform, you would find if somebody invested, you would find volumes to be strong because this is traded there. As far as liquidity on AMC's platform is concerned, for investors above 25 crores, actually both purchases and redemptions put together, we saw volumes of almost 10,000 crores. We have seen investors to the tune of 200, 300, 500 crores coming and going out. And it was done very, very smoothly without affecting the portfolio at all. So it goes to show that liquidity is very strong both on the underlying holdings as well as on the ETF. Let me just come to the performance of last ETF. So the 23 ETF current returns are close to 14%. It's because when we launched the ETF, it was at 6.7%, the YTMs, and today it's at 5.1. So this change in yield has resulted in mark-to-market returns. On Bharat Bond 30, the returns are on the higher side. We had launched it at 7.5. Today the rates are close to 6.7. So you have seen a smart rally, and we feel that that rally may continue. Even if it doesn't continue, people just are required to hold the investment till maturity. So if you hold your investment till maturity, you get your YTMs on the date of investment. In terms of AUM, when we launched the funds, it was around 12,500 crore. As we speak, it is more than 14,000 crore. The current issue is going for subscription live on 14th July. It ends on 17th of July, and allotment will be done within 3 working days. If you have any questions, I'll be happy to answer those questions. From my side, I think I have covered most of the bit which required to be covered. Most of you had invested in the past series and would know the product for sure, but still, if there are some elements which I may have left, I would be happy to answer those questions. Ganesh?
Yeah. Am I audible now? Yeah.
Yes, you are very much audible.
Yeah. So I think thanks, Deepak. I think it was quite an insightful session that you presented. We do have a few questions which I'll bounce it off to you. First is from Mr. Rajul. How does the interest payout happen here?
So it works like a mutual fund. There is no interest payout. It gets adjusted in the NAV. So if somebody wants to, take some kind of a withdrawal from ETF, then it has to be partial withdrawal. There is no dividend payment which happens on the ETF. But on FOF, if you want, there are both dividend and growth options. But I would still suggest that people participate in ETF, and for liquidity purpose or some cash flow needs, can partially sell the investments. But there is no payout.
Okay, great. The next question is from Mr. Shastri.
I can just add a bit. The ETF will receive the coupon on an annual basis, and it will get reinvested.
Okay, great. The next one is from Mr. Shastri. So this Deepak, how different are these from the short-term gilt funds? They may hold gilts maturing during each of the next 5 years in a laddered manner. So assuming roughly 20% to be maturing in each year, the interest rate risk is quite low in terms of such a short-term ETF. What's your view on that?
Yeah, it's a great idea, but the problem is that there is no target maturity gilt mutual fund that I have seen, apart from, I will not name, but there is one long-term gilt fund by a large AMC, which is a very long-term, and there are some funds on the corporate bond fund or dynamic bond fund side, which has either SDL or corporate bonds, etc. But there is no gilt fund with a target maturity kind of an approach. But it's a very good suggestion. In fact, government has taken this up as an initiative, and Department of Economic Affairs is currently in the process of designing possible launch of gilt ETF on the lines of Bharat Bond ETF. But I would really encourage if such a product were to get launched. So today, you suffer. I mean, even if you want to take a call on gilt, you wouldn't necessarily know whether the fund manager will subscribe to that call or not. So, for example, if you invest in a 10-year average maturity gilt fund, tomorrow the average maturity can be 3 years also based on the fund manager's call. Or you get a constant maturity GSEC where the risk remains throughout your life. You don't have a roll down kind of a structure which is available. If it is available, I would like to learn more. But it's a good idea, very good idea.
Great. Thank you. The next is from Mr. Dheeraj Soni. The biggest risk I see is interest rate risk. With growing inflation, the interest rate could go up to maybe 7%. So how will I make profit during the years when interest rate goes up?
So the question is right, and the fact that it's a target maturity, it also answers the question. So intermittently, if interest rates were to rise from here, you may see impact on the NAV. Like you have seen the positive impact, one may also see the negative impact. But if a customer comes with a view that I will hold till maturity, then one need not worry about the intermittent volatility. It will only be notional in nature. Also, with every passing year, your average maturity is coming down. So in a way, your interest rate risk always reduces every year. So for example, let's just take this case in point. So if you start with a average maturity of 5 years, your duration will be close to 3.1. Next year, that duration will be 2.4, and the year after it will be 1.8, and so on and so forth. So with every passing year, your interest rate risk and sensitivity towards movement in rates actually is coming down. And with the fact that if you can hold till maturity, it completely mitigates.
Great, thank you for that. The next question is from Mr. Muthuvel, whether it can be redeemed at any point of time. Yes, it can be redeemed at any point in time. Okay, the next is from Mr. Anant. What was the indicative yield of 2030 ETF as of December 2019, the first one that was launched?
7.5.
Okay. Any max limit per investor? And yeah, there's one more follow-up interesting question from the same gentleman, Mr. Salil. Can it give better returns than 7.1 Government of India bonds?
If you are talking about coupons for the first year, I don't think so. But 7.15 Government of India bonds comes with two riders. Actually, I've been a very big fan of that product before it closed down in the 7.75 avatar for people who are tax neutral. So if you are tax neutral today, also that product is a good product. But if you are not tax neutral, your income will be taxed at maximum marginal rate. So for example, if you are an HNI and you are at 30% plus surcharge, your taxation could go as high as 40%. So let's say your coupon is 7.15. After applying 40% taxation, you'll be sub 5% post-tax return. Similarly, Bharat bond, either 5-year or 10-year, will be much better positioned from a post-tax perspective. Also, an element is that this is a variable coupon now. Earlier, it was fixed coupon. Today, it is variable. Correct me, Ganesh, if I'm wrong.
Yeah. Yeah, so that comes with a variable coupon price, as Deepak mentioned.
Yeah, okay. So it's a variable coupon now, plus the taxation, and it's only available to individuals and HUFs. But if you're tax, it is a good product. I mean, I can't really,
sure, unnecessary. That's fair. Sure. Okay, the next is from Mr. Pradeep. Can we invest via SIPs? Is there an SIP option in this?
So in the FOF mode, if you want to invest, you can do SIPs. On ETF, you cannot.
Okay. The next is from again Mr. Muthuvel. How to apply? Yeah. So this issue opens on 14th of July and closes on 17th. So on 14th, this will be available live in our platform, and you can invest.
Ganesh, it's a good product idea, by the way. You can launch an ETF SIP on your platform.
Yeah. Point taken. I think it's a good idea. Okay. The next one is any leverage available from banks from investment in Bharat bonds from Mr. Virender.
So that one has to check with bond, but I'll give you some context on this. So Bharat bond ETFs, RBI allows it as a corporate bond repo. I mean, it can be repoed, which means if you have a lender, you can actually repo this security and get a lending from that person. But from a small ticket perspective, one has to check with the bank. It will come under LAS perhaps, but it carries one of the highest degree of safety, so it should be possible. Also, stock exchange allows it as a margin in a certain specified format. So many entities treat this as a very safe investment. So yes, lending should can be made available subject to your lender comfort.
Okay. The next is a question from Mr. Vijay. Okay, should I open an account now with Edelweiss or wait until subscription date to buy FF? So there is no, you already have an HDFC trading account, HDFC Securities. So on the day this goes live, which is on 14th of July, you will be able to subscribe for it. Okay. Now, okay. Then another question is, are the yields guaranteed here?
No, well, like mutual funds, you cannot guarantee the yield. What you can do is give an indication based on the index yields. So on a daily basis on bharatbond.in website, you can go and check the index yield as of yesterday. Once the product is launched, we start showing the yield of the ETF also on a daily basis. Today also, you can, if you want to check the your live yield of 2023 and 2030, you can check, but there is no guarantee. The guarantees are not allowed by the regulator for any mutual fund product.
Okay. The next is from Mr. Sridhar. What is the, it's on the stamp duty part actually. What is the stamp duty cost of the original investment and interest reinvested? If you can.
Sorry, I missed that question.
Yeah, so it says it's a question on the stamp duty. What is the stamp duty cost, if any, on the original investment and interest reinvested?
So interest reinvested, nothing. I mean, only on allotment there is a stamp duty, and it is common for all mutual funds. So for every crore of rupees, 500 rupees is the stamp duty. What we have done is that we have made minimum investment amount as 1001 and in multiples of 1 rupee. So we'll try to ensure that if you invest, the refunds amount are the smallest possible, but the stamp duty amount is same for all mutual funds, whether it is ETF or liquid or debt or anything. And for reinvestment of coupons within the ETF, there is no stamp duty.
Okay. The next question. So yeah, you were saying something, Deepak.
I said, does that answer the question?
Yeah, sure. I'm sure it would. Okay. Okay. The next question is says, is there a possibility that Bharat bond might also be trading below the NAV, or is it at par?
So it can.
Just a view on that. Compared to the other
we
products
launched
that we have.
at.
Yeah.
So the question, if I have understood correctly, can the Bharat bond we can trade at a lower value than the par value? Is it?
Yes.
So it's NAV based. So if yields move up from here for some period of time, the NAV has to reflect. So it will act like any other mutual fund NAV. So from that perspective, it doesn't change in terms of valuations or NAV, etc. The Bharat bond NAV also will reflect the true reality of valuation as on given day. So let me again re-explain. Let's say we launch the product at 6.8 in terms of 10-year yield, and after 1 month the yield moves up to 7%. So that will have to get adjusted in terms of NAV. It happened in past also. In February, March, yields had moved up very, very sharply, NAVs fell, but then it again recovered back when yields came down. So it will show the same pattern as any other mutual fund NAV.
Okay. Series 1, what is the present NAV? I presume you're asking for the 2023 that came in first. I can mention both actually. What is the present NAV? And there's one more question. Can you sell the bond before the maturity? Yes, there is no lock-in over here. There's ample liquidity, so there is no lock-in. You can sell it. So Deepak, if you can just mention the current NAVs for both the series that came in December.
I'll do that. I'll do that. I'll do that. You can move on to the next question while I just.
Yeah, I'll do that. We'll go to the next question. You can come back for this answer. Okay. So the next is a question from Mr. Muttuvel. Okay, can you throw some light on how different is it from your regular mutual fund products and more so debt ETFs, debt mutual funds?
So I think I covered in bits. So let me again try and explain. One, this is rule-based investment, so it takes out a lot of discretion away from fund manager, and we have seen that fund manager discretion not necessarily has added too much of value to investors at large. So it's a rule-based approach towards investing. Rules are predefined, both on the index side and on the ETF side. Second, it gives you stability of your portfolio in terms of credit quality. It's all AAA, it's all centrally owned public sector enterprise. It also gives you predictability of returns. So once you lock in your yield and you can hold it to maturity, you know your returns. And this is an aspect of debt mutual fund which people want. People don't want to be a little confused about how much returns you will make, though some of the products can give you higher returns based on the performance, etc. But people would still like to know an indicative value or returns from their investment on a fixed income side. So these are the advantages, and the biggest advantage is in terms of cost. I mean, if you look at most debt mutual funds, would be charging an expense anywhere between 25 basis point to 150 basis point, depending upon which product and for what horizon you choose those products. And this ETF comes at almost zero. So rule-based approach, stability of portfolio, predictability of returns, and low cost. These are the 4 advantages compared to other debt mutual funds.
Okay. Okay, the next question is, what would be the rationale for a 11-year series? Isn't it too long a period, especially for a debt?
I mentioned that. I covered it. So as I said that at all points in time, we would want a 1 to 10 year kind of a maturities being made available, like a ladder of securities. And this can only be done by launching few tranches at one point in time. Last time we launched 10 and 3. Now 3 has become less than 3. So 3 year, 4 months. It does not give you a long-term capital gains benefit. The 10 year now has become less than 10 year. So in 4 months time, this particular series will look like the same that we launched last time. And it also gives you a 10 basis point upward, yield pickup from the 9-year 10 months that we already have. So yes, one is that we want to launch a security which can, give you investment choices for a little longer period of time. And second, it also gives you yield pickup of 10 basis point. There was no point of launching the same one.
Okay, great. So
on the NAV, Ganesh.
Yeah, on the NAV.
The NAV, just a minute. It's 1073.522 on the 23 and 1089.58. So which basically means roughly 9% and 7.3% absolute gains.
Great. Thank you for that. Okay, the next question, can I buy both 10 years and 3 year series from a single HDFC Securities account? Yes, you can do that on your HDFC Securities account. Both the existing funds are listed and you can choose to subscribe to them. We'll go on for the last question due to paucity of time over here, and it happens to be a very interesting question as well. Okay, would it be a good idea to book profits from December 2019 bonds and apply for the new issue, since the returns have been very good so far and may not be maintained?
I can't
We
really
wouldn't want
answer
you to
that
do that, sir,
question,
but
but
yeah, I'll hand it over to Deepak for the answer.
so if you are okay paying the short-term capital gains, or if you are tax neutral and you want to move from a 3-year to 5-year, then yes, it makes sense.
Okay, okay, great. So I think with this, we'll have to come to the end of this session. So thank you so much, investors, for taking out the time and joining us and sparing your afternoon with us. This starts on the 14th of July and ends on 17th. So from 14th onwards, this will be live on your HDFC Securities account, and you can choose to subscribe to it. Thank you so much, Deepak, for a wonderful session. It was quite insightful, and thank you so much for a patient response to all the questions that we had. And we look forward to more of these sessions on this issue itself. Thank you so much, everybody.
Thank you so much. Thank you so much, Ganesh, for having us and giving us all the encouragement and support to provide solutions to your clients. Thank you so much.
Thanks a lot. Yeah, we can end.